Earlier on, I mentioned about the married put position, if you had questions about the radioactive trading limited risk married put approach. And this question came in from Charles, and can you discuss delta opposed position of a deep in the money call with a deep in the money put? Why is that a bad thing to use if premium can be sold to pay for the difference and or more? If 5 to 8% risk management is maintained, what is the problem? Okay, so what I did here is just took a direct result from our search, the married put default search on power options, which reflects the rules in the blueprint for the proper way to control risk and trade the strategy. And what we're seeing here is here's the first married put that came up from Las Vegas Sands. Buying Las Vegas Sands at 60.17. Buying the September 70 strike put for 14.58. 100 shares is going to cost me $7,400, let's just call it $7,475 out of pocket to enter the married put. We're guaranteed to get $7,000 back, the 70 strike price times 100 shares. The stock's trading below it, we can exercise the put at expiration, guaranteed to get $7,000 back. And that is the absolute worst case scenario. If I do nothing between now and expiration, make no adjustments, accept no dividends, the stock remains below 70, my max risk is only 475 or 6.3%. Black swan event where the stocks fall 20% like they did almost a year ago, knock on wood, right? That is almost the year anniversary, folks, isn't it? Next week, it'll be the 1-year anniversary when we were essentially hitting the peak in 2020, right before that decline. But in any case, this is a protective structure that's very useful. The argument is why do I want, if I know all this information about options, I know details, and I don't mean me, I mean you've been trading, you've been researching, you've been analyzing, why are you putting up so much capital of your portfolio to enter into the married put position? And it's because it's one of only really 2 strategies that gives you the proper single-digit risk exposure. Can I substitute an in-the-money long call instead of the stock to be the delta opposed? As Charles mentioned, yes. Here's that exact same structure today. I'd still buy the September 70 put, 14.58, same price for my married put position. And in this case, I'd be buying the September 55 call. It's only 5 points below the current price at 60, and that's 11.08. I chose, in this quick example, the 55. Why? Because it has the same exact delta. Both are at 0.67. They're delta opposed, positive and negative. Total cost is $2,565, a third of the cost that I put into the married put. Maximum risk is 1065 because the time value of the call plus the time value of the put. Up here, I'm only risking the time value of the put. And I've got a positive 1 delta on the stock, not a 0.67. But this is truly delta opposed. The risk, twice as high. Not quite 3 times as high, but it's double. That's common. When you do the in-the-money long strangle, you actually have a higher monetary risk. And yes, you can say, well, if I only want this to represent 1% of my portfolio or 2% of my portfolio, I know how many contracts to buy. But as a comparison, this is a 41% risk of what you invested. Leverage works both ways. You take a 41% loss on a position, you know what you have to get back to break even? About 92%. You take a 50% loss, you need a 100% gain to get back to break even. At a 42% loss, you're talking about a 94% gain on what you have to get back to break even. Okay? And Chuck, you said the call is not deep enough. I know, we're going to run through that example, but you said delta opposed. Delta opposed means same exact delta. Okay? We have other examples where the delta was much higher. And this is going to go to Webb's question, what is too deep in the money? Too deep in the money is when you don't have any activity where you can't buy it. A lot of investors say, oh, just buy a delta of 1 or buy a delta of 0.99. And all those options really have so little activity and open interest, they're almost impossible to get filled on. You have to go to 0.7, 0.8, or 0.85 in most cases in order to get a good fill price on those positions. So this shows you here why we don't recommend the in-the-money Long Strangle. But I was getting to that because I knew that that would be the comment. This is true delta opposed, and it's not a good choice. And you can see that the break-evens are much wider both to the upside and to the downside. Right? My break-even here on the married put is only about 67 or 68. Here we're up to 76 or 77. Same time frame, the halfway point between now and expiration also. All that being said, let's go to where we want to go. We pause the screen here. Let's go to power options because, of course, I'm going to enter these into the portfolio tools as well. Fantastic. There we go. All right, so here we are at the power options suite of tools. And let's go to my portfolio. And here we are in the delta opposed. So there's that LVS married put position. And I showed you the initial one, the 70 and the 55. But I'm also going to use the 70 and the 50, where this delta is closer to 0.75, 0.85. I'm sorry, 0.75 or 0.77 in this case. First, why would I have opened a married put on Las Vegas Sands to begin with? And the reason why is because I have an expectation that the stock's going to move up 3 to 6% in the next 30 days. Let's call it a nice 5% gain in the next 30 days or so. That would put us at about 63.15, right? $3 increase. So what would I expect on my married put if the stock moved up 5% to 63.15 30 days from now to March 12th? Okay, so we'll change the numbers there, and I'll hit calculate, and let me jot this down. Okay, this might have earnings coming up. So I'm going to put this closer to the SIV of 0.42. We'll do the same for the long. We're going to use an SIV of 0.42. That seems to be a closer level to how this is going to react. I'm sorry, folks. Okay. Now that is very odd. Okay, so this is showing me some weird numbers. I'm not sure if it's doing it. It's got to be right, but okay. Anyway, so what it's showing me here is I'd lose 18, and I don't think that's realistic unless this is extraordinarily overpriced, which I doubt. So what it's saying, if the stock moved up 3 points, what I'd normally expect to lose on the put with a 0.67 delta is around 1.7. So we'd still be up 130. Okay, but this is showing us that we're going to lose 328 on the put, even with a delta of 0.42. Sorry, applied volatility of 0.42, and an increase of 310 on the stock. It's not common. I'm not sure what's going on there. In any case, increase in the stock price, movement up, we'd expect to see a gain. We still have a positive delta. Now, let's go to the 50 call and the 70 put. And let's go to the profit and loss chart. And same scenario, why is the call so high? I don't care, but let's just change our numbers again. 63. And again, 312, just 1 month out. Yeah, see, this is not, okay. Well, I shot myself in the foot for this example, but this is commonly what not you'd see. We're going to take them both to 0.42, as I mentioned. I'm going to put both near the SIV because that'd be the 30-day time frame. Okay, let's go to 0.45 anyway. That's strange. I'll explain this in a moment. We'll do it with DAR in a minute, too. That didn't change at all, did it? Wow. There we go. Okay, so with the IVs, we're going to use the DAR example on this. This is not coming up right. If Las Vegas, I know why, but anyway, with a movement of 3% up, you're not at a 1 delta of the stock, and you're still not delta opposed. This is actually a higher delta, remember. This is the delta that we chose at 0.67. In this case, the September 50 I chose, because I knew you'd ask, it would be mentioned that it wasn't deep enough in the money, is closer to 0.77. And we're seeing a 5% move, and we're still not at a profit in this case. What we always see, and I mentioned before that we've done this a lot in the trade comparison videos in different market conditions. And what you commonly see is that if you have a 5% movement on the stock, you expect and usually do see a 2 to 2.5% gain on the married put position. Whereas on the in-the-money long strangle, even if you go deeper in the money, you're still somewhat delta opposed because you can't get to 1 on those calls. And if you go deep in the money looking for the 0.99 or 0.98 delta, there's not a lot of activity to get filled on there. They're very difficult to get into. But long story short, you see a lower monetary gain on the position because of the delta opposition. Whereas we still have a strong positive delta of 1 on the stock and the negative delta of 0.67 on the married put, and that works into our favor. An increase of 5%, we're at a profit on a married put 9 times out of 10, and you're at a loss still on the strangle. It hasn't recovered yet. 7% gain, we're at a 3.5% gain on the married put, maybe a 1% gain, or what would be equivalent to 1% gain. Maybe it's a 5% gain now on the strangle. Yes, in 10 days, the stock jumps 15%. You're probably looking at a 30 to 45% gain monetarily on the strangle. That 15% gain, I'm probably looking at a 7 or 8% monetary gain on the married put. I agree. I'm not trying to fight that at all. Do you commonly find stocks that jump up 15% in the first 10 to 30 days? Even 10%. Does it balance out for you with what you need long term? Now, you mentioned a question. I probably wouldn't do this with either trade right now, Chuck. You know this. But let's take a look at Las Vegas Sands again. And here's my married put. And I've bought the 70 put. So let me go out 1 month, standard March expiration, and let me sell 70 call. It's only 55 cents. I don't normally do this. I'm going to wait for the stock to go up as I'm expecting. And I don't want to sell a call below the put strike price because I'm not in a bearish position. That would create essentially a bearish spread for me. I don't want that. I'm bullish on this position, which is why I opened it. But I wanted to show this because we commonly know what happens when we sell a call against the married put position. Well, it gives us a potential little profit to the upside. Okay, we reduce our risk down a little bit. If I sold the call down here, we'd see a bearish position, which is not what I want. So if I forced the sale early, got that 53 cents now, if the stock's up at 70, we could make 3.9%, and we'd lower the risk down to 6.3%. I'm bringing this up because the other part of the question from Charles was that if you could use premium to be sold to pay for the difference and more, if 5.8% risk management is maintained, which you can't do, what you can do is say that that $1,000, $800 that would be at risk in the money long strangle position, in that case, only represents 1 or 2% of your portfolio, means you're only doing 2 contracts, maybe, or 1 contract. You can do that, but you're not going to get a 5 to 8% monetary risk management on your investment with the money long strangle. You're going to be at 25, 35, 45% of the cost to enter the strangle. That's just the nature of these positions. That leverage works both ways. But because you don't own the stock, because you don't have the true 1 delta in this scenario, if I did the same thing on our money long strangle position, and I got to add the option first, right? We've had that same March 19th call, 70 for 53 cents. Get a good gain here of 29.1%. But now the strangle is completely disaffected, meaning that now as the stock continues to go up, you have reversed your delta. This is still hanging out. Your 51 here, if the stock goes up to 70, might be at a delta of 0.8, might be at a delta of 0.85. At expiration, this call is automatically delta of 1 if the stock is anywhere above it. Just like diagonal calendar spread conversations we've had before, when you hit expiration, why does the diagonal calendar spread come off of the main profit? Because at that point, the delta of your short is 1, and the delta of your long is still at 0.8. So now every dollar the stock goes up, you're giving 20, 15, 10 cents back more on the short call than you can possibly gain on the long. All the while, all the while, excuse me, we're still losing on the 70 strike put as the stock's going up, and we get no more benefit for the long call. I mean, I'm sorry, the max risk is 29%. The max profit is 41,800. That's to the downside now. You've created a complete bearish position where you can still profit to the downside, but the upside puts you at a loss. That's why it's hard to get income from these structures, because you're not in a married put. You're in an in-the-money long strangle. And selling a call as you normally would in a married put takes you out. It takes you out of the position to give you a loss if the stock really shoots up in price. And you're not expecting that, but if it did, this is a strange structure to be in, isn't it? Not unmanageable, but not what I was looking for when I opened the married put position. When I used the stock criteria to select it, this is not what I'm looking for. A comment does come in. Well, simply you could gain more premium to help pay for it by also selling a deeper out of the money put. What do they mean? Well, I sold a call here out of the money, so why don't I sell a put out of the money? Maybe the 50 strike put. Just going to keep it simple. Same expiration. I went to the 70 call, which matched the put that we bought. I'm going to sell the 50 put, which matched the call that we bought. Let's get another 30 cents of premium here on this position. You've got the Batman graph, okay? Lack of a better term, the seagull coming at you here. Two ways to lose now instead of two directions to win if the stock really takes off. I mean, that is one huge advantage of the strangle I have not covered yet, which we always do to have in this discussion. We're trying to illustrate why I don't do it is because when I enter a married put, this is my expectation. Sure, sometimes it does this, it goes down a little bit, but my expectation is a bullish play. And we always see the married put hit a profit faster with common growth in the stock, that 3, 4, 5, 6% against the deep in the money long strangle positions. Now, again, yes, 15%, we're up here in the profit zone, we're up here in the profit zone of both. This is a 7%. This might be a 25% gain on what you invested because of leverage. I can't argue that. I'm not trying to. If the stock falls 15%, you're at a gain. You might be at a gain of 25% because of the leverage in this case, where I'm at a loss of 6.3%, or probably at this point, if it's in the first 30 days, about 4% of my total invested. Both of us can still adjust, of course, but just in the mathematics, I'm not arguing that. You've now created a very strange-ish double diagonal position, okay? The drone graph, as William says, the Batman graph, little seagull flying at you. This is a whole new animal, pun intended, but this is a whole new animal. What this really is a double diagonal. Now, in addition to what you did with the in-the-money long strangle position, it's a form of double diagonal, I should say, but now in addition to what you had with the in-the-money long strangle, you now converted it to something that does this. You're in a double diagonal form, which means now you have to start paying attention to delta ratios of the longs and the shorts for management. Now you have to pay attention to the gamma as well. I think I did an alpha there. I didn't mean that. You have to pay attention to those things you would pay attention to in a diagonal or calendar spread format. This is an entirely different beast now. It's something that's gone way off the board of just trying to find a cheap alternative to a married put position. You're in diagonal spread realm at this point. Now, one last quick thing I wanted to mention. I wanted to show everything is great here and there, but of course, real world discussions are also prevalent. December 28th, 2020. DAR, Darling. Oh, sorry. Let me scroll down a little bit more here, folks. Darling, DAR was trading at 5607-ish, 5650-ish, right about here, okay? Right around in this frame, there's our $56. I know this because this is a married put I was in, and I had sold the 55 call recently on this position, went up to 56. I was considering rolling it, and then I really had to roll it because what happened next was the stock shot up in price. Okay, went as high as 72 and came back down to 68. You know exactly why I'm showing this. I need to move this over, sorry. Here's my married put on DAR. If I opened it well before December 28th, but here's DAR at December 28th. Buy the stock at 56.50, and the July 65 put for $12.35 for risk of about 6 or 7%. Stock is up 18.4%. My liquidation value on the married put is $574. Sell the stock for a 1039 gain. We lost $465 on the put. So I'm at an 8.3% return, or $574. I chose the same distance. Chuck, where are my notes? I'm sorry. On this one here, DAR bought the 65, roughly 9 points, 850 in the money from the stock price of 56.50 on the same date. These are the prices on the historical chain. Same distance from the stock, roughly 850, really about 950, but we bought the 47 call, which had a delta of 0.82. I'm sorry, 0.81. It looks like 0.81. 1340 for the call, 1235 for the put. Stock is up 1039, or 18.4%. Call's gone up $820. That's about the 0.82 delta, isn't it? That's right up on the money. A little bit lower, a little bit off, but it's pretty much a 0.82 delta with a 1039 gain in the stock. And the put has declined the same at 465. Monetary gain is 355, or 13.8%. Percentage-wise, not quite double me, but you're doing great. Monetarily, again, 574. And on the way up, I would have hit a profit sooner, before the delta opposition counter would have taken place. That is real world numbers. Okay? Not saying I could have gotten filled at these prices. Yes, of course, they're end of day, but same fair comparison. The married put I would have taken on DAR on December 28th, compared to the in the money strangle, where the delta on the put was 0.67 and the delta of the call was 0.82. And yes, you have a 13.8% return to my 8.3%, but I have 574 of profit because the true delta of 1, you're at 355. But that's kind of your argument, is the leverage works because you're up 13.8% on your investment. I'm at only 8.3% on a much higher monetary investment. But I think we showed why this is not a direct substitute for the married put position, why it does come with more risk on the position, both monetarily and percentage-wise. And the whole point of the radioactive trade is to set up to single-digit risks, which I can do. We had mentioned before that if on that first Las Vegas Sands position with the 41.5% loss, okay, what has to happen? And let's go back to it. What had to happen for that 40 or 41.5% loss on the Las Vegas Sands strangle position? Let me increase this. Okay, well, this is making an assumption, Charles, that I held the position all the way to expiration, made no adjustments on the trade whatsoever, got no income, did not adjust the call or the put, and the stock stayed right between my two strikes of 55 to 70. Then I take the full 41.5% loss. And I'm saying that if you took the full 41.5% loss on this position, you would need probably a 93, 94% gain on what you have left to get back to the 25.65 cost you started out with in this position. You lost 10.65. Okay, so you've got 15.65 left. I'm sorry, 1,500 left. And so you need a 90% gain on that 1,500, of course, to get, well, maybe not 90 so much, but pretty close to it. Because you got to get back to 25.65 to break even. I enter the position where I have a 6.3% loss. And on my Las Vegas Sands position, that's not it. On my Las Vegas Sands, I'm sorry, 6.9%, 7% risk. I apologize, Charles. On the comparable Las Vegas Sands married put, I would enter with a 7% risk if I did nothing between now and September expiration, did no income methods, did not adjust the put, and accepted no dividends if Las Vegas Sands pays a dividend, and the stock's below 70, I'm at the full loss of 7%, or $520. Still have $7,000 remaining, which means I only need about an 8% gain to get back to break even. Not 92. Not 90 on what I have left, just an 8% gain. That's the important aspect of stacking the market odds in your favor that we talk about with the married put, because I can take a full 6%, 5% loss and only need a 5.3 or 6.8% gain to get back to break even, which is realistic. I take a 40% loss, which I know you wouldn't allow with those in the money strain. You'd close it when you got to maybe a 15 or 20% loss, half of the expected loss. I understand that. But in that case, if you do take the 41% loss, you need a much higher gain to get back to break even. And are you going to experience that on a regular basis? That's the trade-off. This is why we do not advocate the in-the-money long strangle, or what's sometimes called the guts you had mentioned before in a follow-up email, as an alternative to controlling risk and the married put approach, even under the same stocks, even in the same scenarios. We just don't see it working out the same in all the examples that we've done and everything that we've worked along those lines. Oh, let me go back real quick. Sorry. Let's look at the chain for September real quick for this to help with Webb's question he asked a while ago, excuse me. I want to go to September. And he had asked the question earlier on, we were talking about the undervalued options of what is too deep in the money. And I can't even go too deep in the money on Las Vegas Sands to tell you the truth. What are you considering? See, here going up to all that's available, the 80 strike put at 0.840. I should use a different example, unfortunately. But going this far in the money in September only has given me a delta of 0.84, 0.85. Why am I not doing this? Why am I not buying the deeper in the money option for Las Vegas Sands? And in this case, it's because for the protection principle, it's too far in the money. It only gives me a risk of 3.1%, but now the expectancy of profit becomes too low, even though this risk is more than half. And in some stocks, you'll be able to see stocks trading at $60. You can buy the 110 strike put and have a risk of less than 1%. You say, why wouldn't you do that? If you're so worried about risk, why wouldn't you take only a 1% risk or less and go 80% in the money? Because now your expectancy of profit is so low. And you could say, of course, we only need to make up $50 of the risk. You could do that right now by selling that out of the money 70 call. Well, again, what happens when you buy something too deep in the money? You force the sell of a call below the put strike price for a small premium. Maybe I canceled the risk down to the bottom, but remember, I opened this because my target is the stock's going to go up here. And now I've put myself in the exact opposite position that I want to be in. That's why that blueprint, the full course on radioactive trading, is so important, because it helps investors stay away from making mistakes where they try to force an income method or adjustment too soon on the protected position. Yeah, you might have lowered your risk down here, but if you still think the stock's going in this direction, this is not at all the structure you want to be in. So that's what's considered too deep in the money for a put option. Now, I don't think we're going to see it with the call. Yeah, here's where we enter into the weird zone. You can see it right here. Delta, 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 delta. 0.90, the option, Charles, that's available. The 25 strike only has a delta of 0.9. It's not one yet. No open interest. No volume. You are the entire market for that position. Here's some open interest at 35 with the 0.85 delta. Okay, there we go. 40, some small activity. This one is a lot of activity, I got to admit it, 0.88. So let's take the 30. Let's go ahead and take the 30 so we wouldn't be delta opposed. And I'm sorry, folks. That's what I wanted to do. Okay. What am I talking about here? So this is more along what Chuck was originally thinking. What if I did take the deepest one I could get, the 30, and it's still a, what was that? Oh, okay, it's only a 340 bid-ask spread, so $1.70 midpoint. That might be feasible. Open interest and volume isn't great. But see, in this case now, okay, the risk is closer to mine. It's still at 12%. It's double my risk. Monetary risk is higher. And now you're back up to investing $4,575. Not quite half of what we have in that position as well. Would we get a better delta movement? Possibly. in this position, 30 days out of time. But look at that IV, though. That's such a high, when you go that deep in the money, now you also get this extremely high implied volatility of 0.92. The option's probably not going to react to that, but we'll allow it. Okay. So in this case here, gain of $300 in the stock, you're seeing just a gain of 72 on the position theoretically. And again, honestly, with my delta of 0.65, if I see a gain of $3 on the stock in the first 30 days on that initial Las Vegas Marriott put, yeah, I'm going to expect to be seeing a gain on the Marriott put of $1.10, $1.20, $1.30. When I say three, yeah, $1.10, $1.20, $1.30. That's what I'm going to expect to see there, $130 as opposed to this is 75. This put is reacting really weird. It shouldn't be dropping more in either case, in your strangle or in my example for the Marriott put. It shouldn't be dropping more than the increase in the strike price, even though it says it's high. The SIV is highly inflated. That shouldn't be affecting it too much. And I get it. I know what you're trying to do, but that's why we don't do it this way. And then we saw what would happen if you sold the calls against those positions quickly. You sell them at the wrong price and too much. So that's what I was referring to, Webb. I'm sorry, when I said there's such a thing as too deep in the money. You're never going to really see a true delta of 1. And if you do see a delta of 0.99, 0.98, or 1 on some options chains, you're going to see a lot of this, no open interest, no volume. You're kind of creating the market for that option. And that can come back to haunt you for exiting, rolling positions, and much more as well. All right, so that answered Webb's comment. That took really care of Charles' comment. Those are my thoughts, Charles. Of course, as always, you don't have to agree with them. You could run the examples and scenarios yourself on power options, but per our other discussions that we had related to the 3 core principles and trade comparisons of radioactive trading, every time we've run that scenario, we've always come across this idea that it takes the in-the-money strangle longer to see a profit than compared to the Marriott put position because we have a true delta of 1 on the stock. Yes, you're absolutely right. If the stock falls, you're going to be getting closer to a profit on the in-the-money long strangle, and I'm getting closer to the max loss because that's not the directional trade that I wanted. I will use straddles and strangles around earnings, of course. But now the structure of the trade, because you don't have the true 1 delta, when you try to generate income against it, you change it into a completely different position where you can potentially lose to the upside if the stock really ramps up. And again, the most important thing is the monetary risk is always higher. And the percentage risk is higher because leverage works both ways. But the monetary risk higher because you're taking on the time value risk of the put that I have still in the Marriott put, plus the time value risk in the call that you're buying to simulate stock